So today was FOMC day, and we got our expected rate cut. We might not have gotten the expected market reaction though, from what many are deeming to be the last rate cut in this cycle. So I'm going to break that down, the market's reaction, not just in stocks but different other asset classes, and what that means for our market posture going forward from here. I'm also going to break down the technical outlook and what our technical outlook is in the short term, what it is in the intermediate term, and really what's building up some potential energy to get a good breakout move going, and why we haven't really got it yet, but what could fuel it once we do get this breakout, strong breakout, not just in the S&P but in other areas too. So I'm going to show you that. I'm also going to show you a trade idea for a stock that's been beaten up a little bit but had its own breakout now and is showing a decent reward risk pattern to the upside. We'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, October the 30th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see that we finished up with a pretty decent day. A little bit of a long lower shadow. That's not as bearish as a long upper shadow would be, but a little bearish in and of itself. But that's not too much to get concerned with. I mean, keep in mind that the near-term line has been above the chart's midpoint now for 15 days, and the typical time frame is 7 to 12 days. So, you're 15 days into a near-term run, and you're getting a little bit of a, in this case, not as bearish of a signal, but a little bearish signal. That's not surprising, right? Not surprising considering that the posture is strongly bullish. It's the strongest posture the intermediate line's had in a long, long time. Market sentiment's rising above 50. You got the rising moving average. I mean, you can't really be like, this is about as bullish of a pattern as you can possibly get. Even when you look at the 5-year chart, again, strong bullish pattern here. Rising green line, dark green shading, dark bullish posture, near-term line in the upper reversal zone now for multiple weeks. Now, it doesn't mean that we're going to go up like every single day. I know that that's kind of the perception, right? Unless you're going up every day, then the market's volatile, and that's not the case. There's going to be ups and downs, but the downs won't be as big as we saw yesterday. Really, you'll have ups and you'll have small downs, and you'll have bigger ups, and the ups won't be big either. But this kind of shows the type of moves that we'll get, and because market sentiment's rising, you'll have more up days and down days. That's the path of the market sentiment gives us our path of least resistance, which right now is to the upside, right? There's going to be, because it's rising, there's going to be more up days than there are down days, and the down days will be smaller. So that's kind of how you can see we're breaking through, new all-time highs today. In fact, we can now kind of get rid of these Fibonacci retracement levels because we're not retracing anymore, right? We've bounced up through, we've kind of broken through whatever horizontal resistance you want to draw there. We've broken up through there. Again, still wouldn't be surprised if we didn't pull back a little bit here, simply because of 15 days of the near-term line, and 12 days is like the long end. But, I mean, again, any pullback I get, if we get, to whatever extent, it's not going to be trend changing. I tweeted that out. I tweeted out last night. For those who don't follow me on Twitter, I'm at David Settle42, at David Settle. Here we go, David Settle42. Hitchhiker's Guide to the Galaxy fans would understand that reference there. But I totally agree with the idea that we'll get a little pullback. But the problem is, generally when we get the 2% drop, then everyone's like, well, now we're in recession, right? They don't actually take advantage of that 2% drop. So I wouldn't be surprised, but any little near-term pullback we get that would bring that near-term line down below 50, and there's quite a few stocks that actually have done that, then that's not going to be an issue whatsoever. It's just a pullback and a bounce back up, and away we go again. Again, I'm expecting all-time highs. In fact, someone on YouTube, one of your commenters, mentioned that if I go on another vacation, we might get to 3,100 here. And so I'll take that, right? If that's what it takes, I'll gladly volunteer as tribute for that strong bullish move, considering the last vacation got us up to new all-time highs again. Taking a look at the Russell 2000, not as bullish of a story. I mean, we do have the dark green shading. We do have the green line now. Market sentiment's almost above 50, so it's getting there, but we're not clearing these highs in the least bit. We're not to 52-week highs, and we're definitely not to all-time highs. If you notice, the all-time high is still way up here from 2018, way up to 1740. So we're not anywhere close. And again, I shared this yesterday or today with my class, and instead of Netflix, I'm gonna put Microsoft in here. So these are 5 of the biggest market cap companies, and you can see again, while I'm not too bullish here on the I'm not too bullish on this breakout in the S&P until you get this leadership group taking us to new highs too. And you see the last time it peaked was at the end of August too, just like the Russell, the last time it peaked. And while the S&P did get to a new high, this group didn't, kind of foretelling a little bit of weakness in the broader market as a whole. So like the Russell, and for that matter, like crude oil and a lot of other things, we still need to kind of break out above these highs on these stocks before we are like back up the truck, multiple month run on the S&P 500. All right, before we continue our process here, I remind you or invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video that will notify you when these videos are posted. Hit the thumbs up icon down below there too. That lets us know that you liked the video today. Also, it tells us you want us to do the video again tomorrow. So if that's the case, one click. You can do that right now while you're watching. If it's not the case, don't click on anything. We look at that as pretty much our only survey that we have. Also, while you're down there, comment on what you got out of today's video, what you liked about it. Join our website for free at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Subscribing to our site will give you access to our Market Outlook forum, as well as our market commentary blog, as well as other benefits as well as, and of course you can see on the site what our paid subscriptions would bring you. Follow me on Twitter for more content in between these videos, and join our Facebook group that we've created for Market Outlook, for our Market Outlook videos. Also, if you're watching our video here on our blog and you want to watch our trades, see our trades that we do in these videos all the way to the end, here's our link to our Market Outlook live videos. You'll see here that we have a link in our menu here for the Market Outlook. There's a link that will also take you straight to the live trade review videos, as well as the archives for the old ones. And then this is the link that takes you to our Market Outlook forum, where you can chat about or open up any new threads about anything we talk about in these videos. Of course, the Market Outlook live videos are available for all of our Plus and Premium subscribers. Our Plus subscribers, of course, get access to all of our classes. The Premium subscribers get access to everything, including our scripts, our forums, our class forums, everything. So these 2 links will also give you some information on that. All right, back to the charts. Let's take a look at the long-term chart here for the S&P, and look at that nice, good bullish candle. Again, 3 weeks into this run that we expect 4 to 13 weeks. So, and this one, this is different. This week's candle so far is different than all the rest because we are closing above all of these highs. So this one we didn't, right? It was a good bullish candle. We closed like a penny short of the previous week's highs, but obviously well below these. This week we're closing above all these week's highs. So and market the PPO is rising. It's still, you know, relatively low levels. It has been higher. So we'll see how much further it goes up. You look at the 3 green arrow chart for SPY, and you see that we have easily 3 green arrows and a rising moving average. Of course, I want to take a look at the 2-line versions of this. And you can see the MACD histogram is pulling down a little bit. We threatened the 8-day moving average, but we're obviously still above that. Of course, the stages of reversal to the downside are to, at some point in time, touch or threaten the 17-day. And we're not, you know, but we can ride above an 8-day for quite a while. So the buyers are in control according to the stochastics indicator. You have good, strong, bullish momentum on the MACD, and it can get higher and it can stay high. As you can, I'm talking about the orange line, which is the smooth line of the blue. So that, you know, we can get up high and stay high, and that's kind of where we're, where we're approaching right now on the MACD. If you take a look now at the intraday chart, here let's look at right here. You can see, we're the value area. Pretty much we're encompassed inside of the value area of this 4-week range. There's a little bit down here, but that's going to change, right? As this comes off the table, a lot of that volume in the next couple of days will come off the table, and the value area will start to shrink up. And we can, we have a lot of volume up here in this area. So to get above this volume will be a good sign and establish this as a base now. We're really, really close, and we talked about what that means for our options inventory in our class this morning, and how we can offset any damage that can do to our inventory, how we can hedge that if we do break out. You can see on any kind of near-term weakness, as I mentioned on Monday, this is our area that we'd shoot for, 299, 300. In that area, any kind of pullback, there's strong support there. It will be even stronger as the volume here takes off, falls off of the 4-week range. So there's going to be some strong support here. I wouldn't expect a big move. If we did get a big move, we're looking down to 292. That's unlikely. Unlikely that we'd get that side. That'd be about a 4% drop from these highs, and unlikely that we'd get that big of a decline. If you take a look today at the range, under the average, and the volume also a little bit below the average at 49 million. So you put those two numbers into context, and you can see we're just a little bit below the average on the ATR. We're below 1% here. So we are entrenched in this trend. It's going to be a bunch of small moves, right? As long as we stay below 1%, which is 3 points range, that means we're going to get a bunch of small moves. That's how things work. When you're in bullish trends, things get really boring. That's why when you get these strong, high probability bullish patterns, those short verticals work out well, because you can be patient with those trades, whereas directional trades can't really be as patient. There's your volume dropping down to low levels. As these move down, that's what you want it to do. And the volatility index itself has dropped down. Here we go. The volatility index down to now below 12.5 on this late drop, below to extreme levels. So again, another sign of that we can get some short-term volatility, because that's the first time that we've closed below the 80% mark in the last year. To kind of give you some context, when the last time we closed below it. Now, if I was CNBC, I'd be like, whoa, this is the last time the VIX has closed below 80% since August the 3rd or October 3rd of 2018. We all know what happened after that. Well, this is not going to happen after that. But if we get a little bit of a bounce up into, because you can see even that was the first time since August, and you can get a little bit of a move up to the 90% mark in volatility, up towards 15. That's what I expect. That's all I expect on any kind of increase in volatility here in the short term. But definitely getting likely, again, considering how extreme we are here and the fact that we've been on this near-term run for longer than the 12-day long end of the range going forward from here. So good bullish pattern, very high probability bullish intermediate trend we're on, but short overbought in the short term. And expectations, we're threatening the 8-day moving average, and that's probably all we will threaten on any near-term pullback. So before we move into what's driving this market and our trade idea of the day, what do you think about that technical outlook? Do you agree with that assessment? Do you disagree? I'd love to hear your opinion on that. There's a link popping out top right corner of your screen. Hit the link. It opens up a poll, and then vote. Either agree or disagree. As always, I don't consider myself a chart master, so I definitely assume I'm not 100% right all the time. And if anybody has a different opinion than what I have, please share it down below in the comment section. But don't just share your opinion. Share with us what's driving that. So what indicator, what macro indicators, what technical indicators are you looking at that would suggest either that you're more than just expecting some short-term volatility, you're a lot more bearish than that, or this thing is the train has left the station and we're not even pulling back in the short term. So share with us what's driving your opinion down below. All right, now let's take a look at how these different asset classes are performing. You can see the equities here across the top. You've got EFA, EEM, international stocks doing very well. The S&P 500 is doing very well. In fact, the only one really, and if I were to bring up IWM here. It's still got, the Russell's got the green line, but the IWM still, so it's still kind of the one that's lagging a little bit. The rest of these all have strong intermediate postures above 90. IWM is still roughly about 80. If you look at some of these fixed income, bonds are bearish, global bonds are bearish. If you look at emerging market bonds here, you can see they're bearish. High yield, and then you look at investment grade bonds, they're relatively bullish, just pretty flat, which is kind of what you would expect when we got a bullish risk appetite. And you can see too down here at the bottom, the dollar, look at the dollar pulling back down. In fact, if I take a look at DXY here, you can see a little bit of the reversal in the dollar today, finishing down, light green shading because the intermediate line's rising, but that's how close we are to dark pink shading and a red line. So bearish posture on the dollar. Gold is pretty flat because it's bullish when the dollar's bearish, but it's hard for it to get going in a risk on trade. But here's the other problem: is you see crude oil is struggling to really get going too. So like small cap stocks, it's hard for risk appetite to really get going to the upside when small cap stocks are doing just flat. And same thing with crude oil. These are two risk asset classes that need to be breaking out as well. And then finally the yields pulling back a little bit, but still showing strong bullish postures, and we'll feel a lot more bullish about it once it breaks up above this old high point here that caused that reversal in September into early October. I think now that the Fed is done cutting rates, and if you look at the rate cut odds, if you notice here, let me just refresh the page and make sure I'm updated on these numbers. On TV they said that you had to go all the way out to April to have a 50% chance or better of a rate cut. Well, if you notice, there's a 47% chance. Well, now it is up here. 47% chance. I had to go check this for a minute. They're off on this. The odds are right now we're at 150, 175. So I think these have to be corrected a little bit because the current is not here at 170, 200, and obviously there's not an 80% chance that we will hike rates. So my point being is before they kind of let's see if I refresh this, if it will fix it. Before they did this, the odds of a cut past where we're at right now, which again is right here, that's our current odds, was below 50%. So maybe this is the number that should be in this area. There was a much greater, there was a greater than 50% chance that we would not cut rates again by next April. In fact, you had to go all the way out to July to get above 50%. And even then it was like at 51%. And going out to November, the last I had saw before it kind of whacked out here was about a 52% odds of a rate cut by next November. So basically a coin flip, and so in other words, the market is done. Like there's no more rate cuts priced into the market right now, and that's going to really set off the 10-year yield to really get going to the upside with a strong bullish posture and the dark green shading here, and really you can see from a long-term standpoint. TNX, look at that. It's got that gap left to fill, and this resistance above 1.86 to get above, and then we'll start working its way up to 2% and a little bit above. So I actually fully expect that to happen here. You won't see this updated yet, but this is the inflation expectation rate. Of course, this is what you would want this to get back above 2% too, and that will bring yields up. This hasn't been updated, and the other thing that's not quite updated yet either is the yield spread. The one I've been watching is the 10-year minus the Fed funds rate. That was at 0%. Here, let's just go to 1 year. That was still below 0% heading into this meeting. Again, once this is updated after this, break above 0% will be significant for the Fed to be done cutting interest rates. If this falls back down and inflation expectations stay down or go lower, then don't be surprised for rate cut odds to ramp up again, because that's kind of what they're watching. They do not want deflationary expectations, because they are much harder to fight than inflation. Inflation, the rate hikes can really make a big difference quickly, but if you get deflation, it's harder. And in fact, you heard him mention that briefly today. It's harder to fight and takes a lot longer to fight deflationary effects than inflationary effects. As always, looking at the global markets again, this is the best thing to see, because if you recall last year when we were really bullish going into October, we were the only ones that were dark green on this chart. Everything else was pink. And so the fact that everything here is dark green and just about everything has green lines, minus Canada, that's about as bullish as you could possibly get. So in other words, this, aside from the risk trades here in the U.S. with small cap stocks, those FANG stocks replacing Microsoft with Netflix, so I guess FANG stocks, and then crude oil, right? So minus those things, from a global standpoint, very, very broad rally in stocks and global stocks. Very, very good sign for the persistence of this rally. And just to kind of give you an idea of the potential these stocks have to move to the upside, because we don't think that the stocks have a lot of potential because the S&P is at all-time highs. Well, here's Germany just about getting its own golden cross and breaking back up to the upside. Very good sign. You look at Japan, the biggest, outside of China, the biggest economy in Asia, and you can see it's had a golden cross, and it's really taking off. You look at the UK, and it's close to getting its golden cross and getting, a move into positive territory here. You look at China, and China still a little, influenced by the trade war factors, but improving its negative momentum here. So there's a lot of potential for these stocks. They look just as bullish as the markets do, as the U.S. stocks do. Excuse me. Let me pull up this chart here. They look just as bullish as the U.S. markets do here in these 3-month charts. The reality is they have a lot of upside, and the fact that they're participating here means that we've got a lot of upside potential in equities here heading into next year, where we do expect some volatility heading into the election, especially the bigger the toss-up the election is. Will create a bigger bout of volatility in the summer and heading into November of next year. But until then, and the rest of this year into the early part of next year, lots of potential for upside in equities, based on this broad participation in this in the beginnings of this intermediate run. Interestingly enough, not all sectors are looking dark green. So in terms of broad participation, we are getting it across the cyclical areas. But discretionary and communication services still kind of behind and need to catch up. Materials is doing well with industrials, but look at energy. Dark pink shading and red line on energy with this drop today. So just like that, energy is back to being the weakest sector out of all of these. You can see utilities, a little bit of a bounce up today. Not surprising that it's pink too, right? Real estate's light pink, even with this bounce back up. So I expect those to lag. And staples to some degree too. It's pretty darn sideways there, despite the dark green shading and the green line. But look at healthcare breaking out, doing really well, and it's financials, industrials, materials, and these. Everything's looking really, really positive from a kind of, again, a broad participation rally here. If I just look at how these performed today, right here, and then let's change. You can see the winners, and again, where the pain trade is, right? The pain trade is for these up here, the winners, the people who had these gains to lose them, and for people to short these to start to uncover those shorts, right? So if I take a look now at today's move, just intraday chart, You can see energy is obviously the biggest loser, but look at utilities up. In fact, utilities and staples were up all day long today. A little bit of a risk off today with financials, materials down before that late rally. Materials and financials still finished weak. Communication services finishes below the markets. Everything else doing pretty well. In fact, if I go back and take a look at the last 5 days, that's a pretty good. It's not you would like to see discretionary and communication services here, but these are still good sectors to have, showing some gains alongside technology with above market gains. And then you can see your energy notwithstanding, the rest of these staples, utilities, and real estate showing lagging performance, which is what you would expect. So for our trade idea of the day, which again we've already placed in our Market Outlook live video, again you can get to that here or with this link to live trade review video. We've already placed a live trade today, and again we're not done. Like a lot of times you'll watch videos, classes like this, even free ones, where they'll give you this trade idea, that trade idea, this trade, but it's another thing to follow those trades all the way to the end. And that's what we do here. So we continue to manage and talk about how to close out the trades and how to manage risk for these trades. So it's a pretty broad discussion. But today's trade idea, you can see that we did was on PayPal. PayPal is a stock that has been a little bit behind. It's been struggling. But look at that nice transition candle that we got on the earnings last week. And then the bullish candle, not quite closing above the high, but we're getting closer. You'll see that as a common theme as we're close to some breakout patterns on PayPal. If you take a look at its market forecast chart, it's got the bullish pattern. Now with this breakout, you got the bullish pattern, dark green shading, dark green line. If you look at the 3 green arrows, and we'll just go straight to this chart here, you have both the 8 and 17 day crossing up above, getting above these highs here on the breakout. The moving average of the MACD is crossing above 0. The moving average for the stochastics is crossing above 50. The RSI and the CCI, we'd like to see that RSI get above 60, be above 60. You'd like to see this be above 100. You notice it doesn't stay above 100 for too long, so it's not surprising we got this dip here. But we're almost there on the RSI. The other thing too about the DMI, you can see for PayPal, the DMI's got the positive index above 25 on the breakout, but it still hasn't been enough to bring the negative directional index down below 25, much less below 20, which is where we want it to be. So there's still a few things left here, and you look at its Bollinger Bands, PayPal. Obviously, we got briefly got above the upper band there, changing the trend to the upside. And you can see the point of control. So we're really close to that point of control. But again, breaking that point of control and you don't have another resistance. It's got pretty decent potential because we moved down so quickly off of those highs. And we moved up to those highs pretty quickly too. You don't have a whole lot of volume up above us to hold us back as it moves higher again. So got good bullish trade, a good bullish pattern already. And then the potential for a breakout as we kind of approach some key levels and all these other indicators. So what I did on the trade then is I set up a long call vertical spread where I sold the 115, bought the 120. This is what the risk profile looks like. So because we're through earnings, I can position size around a full position. So worst case scenario, I lose my risk what I normally do. But of course we'd cut that in half. The idea is that we would cut that in half if it broke back down to 102. So that would be breaking back down essentially below into this gap. So it'd be kind of like this dead cat bounce and inverse dead cat bounce, but breaking back into the gap. So if that happens, we'll close out the trade with a 50% loss. But if it continues to go to the upside by December expiration, then I can get a $2,500 reward for that $480 loss. So almost a 6-to-1 reward to risk ratio, about a 5-to-1 plus reward to risk ratio. I'll take that. We'll take that reward, the risk ratio to the upside, if this does indeed work out as the chart suggests. Again, you can see there's the one standard deviation. So 115 is still within. That's a nice, good potential move that we can profit really nicely from. with just a little bit of our risk, we can profit really nicely and get a good, decent return for what we're putting at risk on the trade. All right, so that does this for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That will take you to our Market Outlook forum. I also showed you in the menu where you can get to our forum as well. You have to be a free subscriber, but I showed you how to do that earlier as well. But open up any new thread that you have any questions or comments about anything we talked about today, whether it's our trade idea or anything else we talked about, or if you have any questions about anything I didn't talk about that pertains to the subject. Open up any new threads, reply to other people's threads, and let's keep this conversation going in between videos. As always, thank you for watching. Subscribe to our YouTube channel, hit that thumbs up icon, comment on our video, follow me on Twitter for more content in between the videos, and join our Facebook group for Market Outlook viewers, as well as our website, as I showed you before. Have a great rest of your evening, everybody, and we'll see you all next time.